A true titan of the media world, a fortress built on some of the most iconic brands in history, is up for sale. But here's the twist that has Wall Street buzzing. The biggest, most aggressive player in the entire game, Netflix, just looked at the deal and walked away. Right here at Iron Financial, our job is to help you forge a stronger portfolio by cutting through exactly this kind of market noise and weakness. So today, we are grabbing our hard hats, we are rolling out the blueprints, and we are going to stress test the very foundation of Warner Bros. Discovery to find out what Netflix saw that made them run. Let's get to work.
Okay, let's just pause on that for a second. Is this just corporate doublespeak? You know, the kind of PR line you feed to the press to save face after you get into a bidding war and lose? Or is this something more? Could this be a massive red flag waving in plain sight? Think about it. The team at Netflix, a company known for its data-driven decisions, did all the homework. They looked under the hood, they ran the numbers, and they decided this fortress wasn't worth the asking price. That's the real billion-dollar question we're digging into today. Is this a gem, or did Netflix spot a fatal flaw?
All right, here's our blueprint for the analysis. We're going to tackle this methodically. First, we'll establish exactly why this media titan is even on the auction block to begin with. Then, and this is crucial, we are inspecting the foundation. We're looking at the core financials, the steel beams, and the concrete. After that, we'll get into the drama. We'll break down Netflix's initial bid, and then the shocking rival proposal from Paramount that changed everything. And finally, we'll deliver the verdict. We'll weigh all the evidence and determine if WBD is a solid structure you can invest in, or if it's a financial trap just waiting to spring.
So let's just set the stage here, because you have to ask the obvious question. Why on earth is a company that owns HBO, the gold standard of television, the Warner Bros. Film Studio, all of DC Comics, CNN, and the entire Harry Potter universe, why is it being broken up and sold for parts? I mean, on the surface, it sounds completely insane, right? These are brands that other companies would kill for, assets that take a century to build. So why would you ever want to dismantle an empire like that? There has to be something going on behind the scenes, some immense pressure that forced management's hand.
Well, the official story, the line they gave the market back in June of 2025, was all about unlocking shareholder value. Now that's classic corporate speak. The idea was that the sexy, high-growth content-making machine, the Warner Bros. Side of the house, was being held back, weighed down by the older legacy Discovery Global assets. So the theory goes, you split them apart and you create two leaner, more focused companies. But let's be real. What this announcement really was, for our purposes, was the starting pistol for a massive M&A battle. It was a giant neon sign flashing to the entire market. The crown jewels are now officially for sale. Place your bids.
So before we can even begin to understand the bidding war or why Netflix ultimately walked away, we have to do our own due diligence. We need to inspect the asset itself. We have to examine the structural integrity of Warner Bros. Discovery's core business pillars. Is this company a true fortress, built on solid granite with deep foundations? Or is it something that just looks good from a distance? A house of cards, built on shifting sand, ready to come crashing down at the first sign of real economic trouble? There's only one way to find out. We're going straight to the numbers.
Okay, let's start with the strongest part of the entire structure. This right here is a massive, solid steel I-beam supporting the whole enterprise. The studio segment is an absolute powerhouse. It wrapped up 2025 with an incredible $2.55 billion in adjusted EBITDA. Now, for anyone not familiar, just think of adjusted EBITDA as a pure look at a business's operational profitability before you factor in things like interest and taxes. It really tells you how healthy the core business of making movies and TV shows is. And a 52% increase year over year? That's not just growth, that is explosive. They had 9 films open at #1 at the box office. This division is a well-oiled, cash-generating machine. This is the bedrock of the company.
And here we have the second major pillar holding things up, their streaming business. Their direct-to-consumer division is absolutely executing. Management set a target of 130 million subscribers, and they blew right past it, ending the year with nearly 132 million global subscribers. And the momentum isn't slowing down. They're on record projecting they'll soar past 150 million by the end of 2026. This isn't just a side project. This demonstrates real global scale, huge demand for their content library, and a clear, viable path forward in what is arguably the most important battleground in media today. This is the modern engine powering the whole operation.
Whoa, wait a second. Hold on. Let's pump the brakes right there. If your streaming engine is firing on all cylinders and your growth story is so fantastic, why in the world would you suddenly decide to stop reporting the very metrics that prove it? This, to me, is a massive red flag. It's like a builder telling you how strong his new skyscraper is, but then saying, oh, by the way, we're not going to let you see the reports from the concrete stress tests anymore. When a company that lives and dies by its growth story suddenly decides to hide the numbers that measure that growth, you have to ask, what are they expecting to happen next?
Are they trying to get ahead of a slowdown, or are they trying to hide from us? And this right here, this might be what they're worried about. This is the first major visible crack in the foundation. While management is pointing over here at the shiny, fast-growing parts of the business, the overall structure is actually shrinking. Just look at the top-line revenue, the total amount of money coming in the door. It fell from $39.3 billion in 2024 down to $37.3 billion in 2025. That is a $2 billion hole. You simply can't build a strong future on a foundation that's eroding. A contracting top line is one of the most serious signs of underlying weakness you can find in a company.
Okay, let's drill down into that weakness, because the skeptic is right to sound the alarm, but the problem isn't everywhere, it's concentrated. As you can clearly see in the numbers, the streaming revenue is up a decent 5%, and that powerhouse studio segment we talked about is up a very healthy 9%. The real problem, the giant anchor that's dragging this entire company to the bottom, is the global linear network segment. That's the old-school traditional cable TV business, and it's down a catastrophic 12% in a single year. This business isn't just declining, it's an ice cube melting in the sun.
But, and you absolutely cannot overlook this, despite that linear business decaying, you have to give management some serious credit for the incredibly heavy lifting they've done on the bottom line. Just look at this turnaround. This is a company that posted a staggering $11.3 billion loss in the prior year. And in just 12 months, they managed to swing that all the way to a $727 million profit. That is a $12 billion swing on the bottom line. It shows immense financial discipline. It proves they've managed to stop the hemorrhaging and stabilize the patient, even while one of its main limbs is withering away.
Stabilized? Analyst, how can you possibly use the word stabilized when you're staring at this number? $29 billion, with a B, in net debt. This isn't just some crack in the foundation we're talking about anymore. This is a demolition-grade wrecking ball hanging directly over the entire structure, ready to swing. This is the toxic legacy of that massive Discovery merger, a literal mountain of debt that has to be paid quarter after quarter no matter what. It doesn't matter how many hit movies you make if you're being slowly crushed under this kind of weight. This debt is the reason for everything. It's the reason for the for sale sign out front.
And that crushing $30 billion debt load, that constant financial pressure cooker, that is exactly what put blood in the water for a shark like Netflix. And that brings us to the main event, the M&A drama. Netflix, the undisputed king of streaming, saw a potential once-in-a-generation opportunity. With WBD clearly weakened and desperate, they saw a chance to swoop in and acquire a century's worth of legendary content. Batman, Harry Potter, Game of Thrones, the entire HBO library, to fortify their own empire for the next 50 years. And they probably figured they could get it all at a serious discount. And don't make the mistake of thinking this just happened overnight. This timeline clearly shows a very deliberate, methodical process by the WBD board to put the company in play. It all started back in late 2024 with a vague strategic review. Then, in June 2025, came the public announcement to split the company. By October, it became a formal review process. They were carefully, deliberately laying out breadcrumbs, creating a clear path to a sale. And then, in December of 2025, they landed their whale, a definitive, signed merger agreement with Netflix. At that moment, for all intents and purposes, it looked like the game was over.
But just when everyone thought the deal was done and the ink on the contract was drying, the story took an unbelievable, dramatic turn. Out of nowhere, a rival contender, Paramount Skydance, charged into the arena. Now, they weren't part of the original process, they weren't invited to the party, but they showed up anyway, and they threw a competing offer on the table that was so strong, so compelling, that the board at Warner Bros. Discovery had no choice but to take it seriously. And just like that, a simple acquisition turned into an all-out, high-stakes bidding war.
So, to understand how this was even possible, you need to know this key legal term: company superior proposal. Now, when two companies sign a merger agreement, it's a legally binding contract, but there's almost always a built-in escape hatch. The contract says that if an unsolicited third-party offer comes in out of the blue that is clearly demonstrably better for the shareholders, the board has what's called a fiduciary duty, a legal obligation to consider it. That clause, that little piece of legalese, was the battering ram that Paramount Skydance used to smash down the door on the Netflix deal.
And this right here was the moment everything changed. February 26, 2026. The WBD board put out a press release and made it official. They publicly announced that the offer from Paramount could lead to a superior proposal. Now, this wasn't just a formality. This was a direct and very public challenge to Netflix. WBD was essentially lighting a fire under the negotiation table. turning to Netflix in front of the entire world and saying, "The price of this company just went way up. Your move. What are you going to do about it?" All the pressure, in that single moment, shifted entirely onto Netflix's shoulders.
And that brings us to the final act of this corporate drama. In a move that truly shocked Wall Street, Netflix looked at the higher price tag and folded its hand. They walked away. And that leaves us to sift through the wreckage and answer the most important question of all. Did WBD's board just brilliantly engineer a bidding war to squeeze every last drop of value out for their shareholders? Or did the new winner, Paramount, just get caught up in the heat of the moment and massively overpay for a beautiful but structurally flawed asset?
I mean, you really couldn't write two more completely opposite narratives. On one side of the table, you have WBD's management taking a victory lap, publicly boasting that their rigorous and highly competitive process resulted in a jaw-dropping 63% increase in value from the first offer they got. But on the other side, you have the co-CEOs of Netflix, one of the most respected management teams in the business, stating bluntly that at this new, higher price, the deal is simply no longer financially attractive. So who do you believe? The proud seller celebrating the high price they got, or the sophisticated, disciplined buyer who walked away because they thought it was a bad deal?
Well, in finance, actions always speak louder than words. Netflix didn't just quietly decline the offer. They immediately turned around and announced that they would be resuming their share repurchase program. Now, this is a critical signal to the market. What Netflix is explicitly telling its investors and the world is that they believe that taking billions of dollars of their capital and buying back their own stock is a better, safer, more value-creating investment than buying Warner Bros. At the price Paramount was willing to pay. That is a powerful and frankly a pretty damning verdict on WBD's valuation.
So, let's lay out the final bull case. This is the argument for WBD being as solid as a rock fortress. You have a dominant, world-class studio firing on all cylinders, with 52% EBITDA growth. You have a rapidly growing global streaming platform on a clear path to over 150 million subscribers. You own an absolutely irreplaceable library of intellectual property that is the envy of the entire industry. Management successfully executed a massive $12 billion turnaround to profitability. And you can't deny that they successfully ran a bidding process that drove up the final sale price by a whopping 63%. These are strong, tangible, undeniable assets.
But then there's the bear case, the argument that this entire beautiful fortress is really just a house of cards. First, the company's overall revenue is actively shrinking, down 5% year over year. Second, a huge piece of their business, the linear networks, is in a 12% nosedive. Third, the entire structure is groaning under the immense weight of a $29 billion debt load. Fourth, free cash flow, the oxygen a company needs to invest and survive, is down 30%. And maybe the most damning fact of all, the smartest, most data-driven, and biggest potential buyer on the planet took a long, hard look at all of this and decided to walk away from the deal.
And so, this is the ultimate question we leave you with at Iron Financial. Is Warner Bros. Discovery skillfully using this sale to shed its decaying assets and forge a brand new, stronger foundation for the future? Or are those deep, structural cracks, the massive debt, the collapsing linear business, the shrinking cash flow, so severe that the entire enterprise is actually facing a slow-motion financial meltdown? We've laid out the evidence, the bull case, and the bear case. Now it's up to you to decide, is this a fortress of opportunity, or is it a trap?
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.